Imagine discovering you've been ripped off on your car loan for years, only to find out the so-called solution might leave you even further out of pocket. That's the shocking reality facing millions of drivers caught in the UK's car finance scandal, where victims could be denied over £4 billion in rightful compensation due to what critics call an outrageously low interest rate slapped on payouts. But here's where it gets controversial. While the Financial Conduct Authority, FCA, insists their plan is fair, consumer advocates are crying foul, claiming it's a slap in the face to those who were overcharged, sometimes more than a decade ago. Stick around, because this isn't just about numbers, it's about justice for everyday folk who trusted lenders with their hard-earned money. At the heart of this issue is a long-running scandal involving unfair commissions paid to car dealers by banks and specialist lenders. Picture this: when you finance a car through your bank or a dealership, those lenders often paid hefty fees to salespeople, inflating the overall cost of your loan without your knowledge. The FCA has identified around 14 million such historic contracts that could be ruled unfair, spanning major players like Lloyds, Barclays, Close Brothers, and even the finance arms of automakers such as Ford. To make things right, the FCA proposed a redress scheme that would cost these lenders a whopping £11 billion, with about £9.7 billion going directly to consumers after administrative fees. But here's the kicker: the average payout per person? A mere £700. And that's not even the full story. Critics argue this scheme robs drivers of an additional £4 billion they deserve, all because of a ridiculously low annual interest rate of just 2.09% applied to the compensation. If you're wondering why interest rates matter here, let's break it down simply. Compensation isn't just handed out like a gift. When money is owed for a lengthy period, think years of unfair charges, the interest accounts for the time value of money and the loss of what you could have earned or saved. For beginners navigating this, imagine lending a friend £100 for a year at no interest. You've effectively lost the chance to invest that money elsewhere. In this scandal, the FCA's proposed 2.09% rate pales in comparison to what borrowers should get, leaving victims shortchanged on the true value of their redress. The controversy ramps up when you compare this to the benchmark set by the UK's highest court. Take Marcus Johnson, a factory worker who became the lone victor in a landmark Supreme Court case in August. His victory showed that borrowers deserve what's known as a commercial rate of interest on their compensation. While the exact details of Johnson's payout are confidential, industry insiders estimate he secured around 7%, a far cry from the FCA's 2.09%. Judges in that case ordered the parties to negotiate a fair commercial deal, emphasizing that victims shouldn't be penalized for the lender's wrongdoing. Johnson represents hope for millions, proving that justice is possible, but the FCA's blanket approach risks undermining that win for the masses. Critics aren't holding back. Darren Smith, managing director of claims firm Cormax Legal, calls the 2.09% cap frankly insulting to the millions of overcharged consumers. If the tables were turned and a bank was the successful claimant in a dispute, would they settle for such a cut-price rate? Smith questions, highlighting what he sees as a staggering hypocrisy. He points to Lloyds Banking Group's CEO, Charlie Nunn, as someone who would undoubtedly demand full commercial rates if the shoe were on the other foot. This raises a provocative point: why should everyday borrowers accept less than what corporations would fight for? And this is the part most people miss: the scheme aims to close the book on the scandal, but at what cost to fairness? Even financial guru Martin Lewis, founder of MoneyExpert, weighs in, calling the rate way too low on his recent BBC podcast. He's gearing up to challenge it in the FCA's consultation, urging a rethink. Kevin Durkin from HD Law, who represented Johnson in court, echoes this, labeling the proposals unfair and insufficient for the years of hardship endured by borrowers. The FCA's scheme should mirror what the Supreme Court awarded to Mr. Johnson, Durkin insists, stressing that true redress means accounting for prolonged unfair lending relationships. Consumer rights champion Alex Neil from Consumer Voice adds fuel to the fire: the proposed interest rate is unacceptable, potentially costing drivers £4 billion they are entitled to, and suggesting victims negotiate individually for better terms. That's just not practical for those already burdened by this mis-selling mess. For context, if the rate were bumped to 8%, a level historically used in county court judgments and by the Financial Ombudsman Service before recent cuts, total payouts could soar to £14.3 billion, boosting the average compensation to about £1,030 per person. That's a tangible difference for someone who's struggled financially due to hidden fees. Of course, not everyone agrees this is a raw deal. The Financing and Leasing Association, FLA, argues the 2.09% aligns with recent changes at the Financial Ombudsman Service, where rates dropped from 8% to the Bank of England base rate plus 1%. The FCA is following the same logic, the FLA states, suggesting it's proportionate. The FCA itself defends the plan, noting it considers court precedents and ties interest to the Bank of England base rate for fairness. Consumers can contest it if they prove unfairness, an FCA spokesperson says, welcoming feedback. Lloyds Banking Group chose not to comment, leaving more questions than answers. This isn't just a numbers game, it's a debate about equity in finance. Should victims of a systemic scandal settle for pennies on the pound because of bureaucratic decisions, or should they demand the full commercial compensation that reflects real-world losses? What do you think? Is the FCA's 2.09% rate a fair compromise, or an insult to consumers? And here's a controversial twist: if banks can demand high rates when they are owed money, why shouldn't borrowers? Share your views in the comments. Do you agree with the critics, or does the FCA have a point? Let's discuss.